On our last episode, we discussed why utilities are a great option for our portfolios as we enter the red zone. First, due to their stability, and second, due to the distributions they pay, as we need to replace our W 2 employee income with a portfolio that pays us from here on out. If you missed that episode on utilities, you can see it here. If you saw it or you're just here for the fun reviews, make sure you subscribe and then let's get into it right here in the red zone. All right, here we go. Today we'll take a look at these six funds: tickers BUI, DNP, ERH, HTD, UTG, and UTF, all of which are closed end funds. If you're unfamiliar with that type of investment vehicle, you can check out my overview of closed end funds here. Before we get into round one, let's introduce our funds. Here's a summary from my last video on some general characteristics that I liked about these funds. For example, the fact that several of these funds have recently increased their dividends, the yields that some of these pay, or simply their reputation in the investment community. I will say all of these funds have positives, especially in the current investment climate for the utility sector overall, as not only should they provide stability for your portfolio, they should also reap benefits from a build out of AI power generation. What I'll walk through today is a summary of how I arrived at the fund that I invested in. As always, I encourage you to continue to do your own research prior to making any investment decision. Now, before we get in any boxing match, we need to do the weigh in. Here, we want to look at assets under management or AUM to see if we have any funds that are going to really have to punch above their weight class in order to get our attention. We see ERH weighing in at less than 200 million in AUM. Now, this may or may not be in your screening criteria, but I generally prefer to see at least 500 million in AUM prior to committing to investing. Since this fund doesn't meet that criteria, it's out for me. I will keep updating some of its common measures throughout the video in the event that's not a reason for you to shy away from a particular fund. On to round one. The most important metric here is total return. Now, we don't care about total return versus the S&P 500. We're not trying to beat the market. In fact, that's the opposite of what we're trying to do here with utilities. What we do care about though is total return compared to similar assets, which we can see here. What's interesting is that we see the same general story with each one of these funds in a comparison over the 3-year, 5-year, and 10-year time periods. Looks like round one was pretty close, but our initial winners of BUI, then UTF and UTG separated themselves from HTD and dropped the hammer on DNP. Sorry, DNP. Looks like you got knocked out in round one. In round two, we want to look at the dividend. We're interested in both the forward yield, as many of these funds have recent dividend increases, as well as taking a look back at their dividend history. The order from highest to lowest in forward yield of our remaining funds is HTD, then UTF, UTG, followed by BUI. This yield is obviously going to be highly dependent upon the price the fund trades at going forward. In fact, if we take a look at the dividend yield history of these funds, we can see that they usually yield more than they're currently yielding. If we take a look at their current yield versus historical yield, BUI has the smallest gap, while it's been over 2 years since UTF and HTD's yields have been so low, while UTG's hasn't been this low since around Christmas of 2021. In other words, you're technically paying more for these distributions currently, but we would have paid about the same amount at other times of similar price appreciation. Looking at dividend history, these funds all look really impressive in terms of maintaining a consistent dividend payout. I'll quickly flip through these over the last 10 years so that you can see them. BUI, which increased its dividend at the end of last year, HTD, which increased its dividend at the end of July, UTG, which increased its dividend last month, and UTF, which remains consistent but hasn't had any increases since December of 2017. Because these funds are all close and we can't see any red flags other than they could all be trading at higher than their historical premiums, no fund gets knocked out. On to round three. We'll take a quick look at leverage. For me, less leverage is better, but for you, that may not be the case, especially if you expect this sector to benefit from the AI infrastructure buildout. You could want higher leverage, as it has the potential to boost your total return. Since I am not chasing outsized gains in the red zone, lower is better for me, and my general threshold is around no more than 30%. BUI wins because it has no leverage. I am tempted though to call it a draw with UTG because BUI uses a covered call strategy as opposed to the other funds using a leverage strategy, but I'm pretty much good with the others except for HTD, which is our most levered fund at 31.23%. I would consider it because it's around that 30% range, but in this particular category, it seems more of an outlier, which is enough for me to screen it out for purposes of this exercise. Now for round four. Our mostly equity CEFs primarily source their distributions from capital gains, but we will see return of capital as well. So for this round, we are on the lookout for a destructive return of capital as a signal that the distribution will not be sustainable over time. Starting with BUI, we see an ROC of 32.9% from 2022 to 2024, but its total return is greater than its distribution over that time period, and recently, ROC seems to be trending down. Moving to UTF, we have some ROC in its distributions, and we also see that its total return is less than its distribution, indicating that there is, in fact, some destructive return of capital with this fund. Looking over a longer period of time puts us more at ease as we see a growing NAV since 2015. For purposes of this exercise, however, we're going to go ahead and knock out UTF. Moving to UTG, we don't see any return of capital in our CEF data source, but when we pivot over to Fidelity, we do see some return of capital in the distributions, so we'll run our similar screen here. Our total return is roughly double our distribution, so we don't have destructive ROC at play. With that, here's our round four scorecard with just BUI and UTG left standing. On to our final round. In our final round, we're going to take a look at Z score, which basically tells you how much the fund is trading at either a premium or discount as compared to its historicals. Best case, a Z score of -2 or less would indicate that it could be a great time to start a position in a particular fund. However, it could also indicate that the fund is having some major challenges, which is why whatever screens you personally run, I would recommend running the Z score screen as your final one. BUI's 90, 180 day, and 1 year Z scores are all positive. With the longer we look back, we get above a 2, which generally tells us that it's a bad time to start a position in a particular closed end fund. Looking at UTG, we see positive Z scores, but they're closer to a 1. So it's not a great time to start a position in UTG either, but it's better than BUI. Congratulations to our winner of this utility themed Battle of the Funds, UTG. Now, just because we have an overall winner, it doesn't mean that I'm rushing out to invest in UTG, as the recent run up in utilities makes the overall sector pricey. However, if you have high expectations due to the macroeconomic environment, or if you see the power generation needs of AI being a primary driver of investment here, then this could be a great time to invest. So, which fund is right for you? Feel free to leave a comment below to let the community know which fund you invested in or are considering and why. Until then, I'll see you next time right here in the red zone.